Typically with DSCR loans, we're looking at about 20% to 25% down payment, somewhere in that ballpark. Can you go to 15% down? Yes. Typically that's for an experienced investor. At least you own at least one property. The lender may require a higher reserve requirement, which I'm going to touch on in a second, and a higher credit score if you're going to go 15% down. Because take into consideration, you are now shifting more risk back to the lender because you're going to go into this investment with less equity in the property. Now, instead of 20% down, 20% equity position, right? You're at 15% down, a 15% equity position. It's more risk there for the lender because these loans don't have mortgage insurance. So if you default, there's no insurance for the lender. The minimum credit score to get it done varies from lender to lender. Just some lenders are willing to take on more risk and go with a borrower that has a lower credit score, or they will offset it by you having another compensating factor, right? Like I mentioned before, lower credit score, they may say, look, instead of 6 months of reserves, we need 12 months, right? Lower credit score, they may say instead of 20% down, you need to put 25% down. So what you're doing is you're shifting some risk away from the lender in another way because you're a higher risk borrower because your credit score is lower. So there's always things offsetting each other when you're dealing with mortgages, especially when you're dealing with a business purpose DSCR loan and other products too. You have more leeway with FHA and VA. Once you get into this area, conventional and the non-QM loans, there has to be things that tend to compensate for weaknesses in the application, and you're showing strength in another area.